International Accounting Standards. Introduction. The expansion of global interactions, especially in terms of the global market, led to the need for the enactment of international standards. Therefore, international standards are normally developed by global or international organizations to regulate the operations of various processes that are carried out internationally. International standards aim to bring global organizations on par regarding their system operations. This way, they help most nations overcome the technical barriers that could hinder them from operating globally. Among the various international standards that have been developed are the International Accounting Standards. These have come in handy to help most accountants and accounting firms overcome the transaction barriers that existed before the development of these standards. This paper will, therefore, explore the development of the International Accounting Standards and look at their implementation in most countries. The paper will also provide a list of the International Accounting Standards and their role in the accounting world. International Accounting Standards, IASs. In 1973, the International Accounting Standards Committee promulgated the International Accounting Standards, which detailed and explained how various business transactions and other particulars were to be reflected in enterprises' financial statements. Most of the business enterprises operating globally were required to comply with all the specifications of the IAS. Nevertheless, 2001, the International Accounting Standards Board changed the International Accounting Standards to International Financial Reporting Standards, IFRS. Despite the change of name, they served the same function, to guide how companies and other business enterprises report various particulars in the financial statements. The functions of the International Financial Reporting Standards. Before a company from any country considers doing business outside its scope, which is in the global market, it has to consider the restrictions imposed by the governments of its target countries. Most often, barriers exist that could hinder any business transactions between different countries. Because of this, the International Financial Reporting Standards were developed to harmonize business operations within countries worldwide. As such, they ensure increased transparency in reported financial standards since the reporting methods are similar to those stipulated in the IFRS. The development of these standards can be said to have created level ground for global businesses. Examples of the International Accounting Standards. The list of international accounting standards is almost endless since new standards are created almost daily, given the developments in global business. Therefore, business enterprises and companies must be on the lookout for new standards to provide updated financial statements. Below is a list of the 9 accounting standards that must be strictly followed by any company that seeks to comply with the International Financial Reporting Standards in its accounting function. They include IAS 1 Presentation of Financial Statements, IAS 2 Inventories, IAS 3 Cash Flow Statements, IAS 8 Accounting Policies, IAS 10 Events after the reporting period, IAS 16 Property, Plant, and Equipment, IAS 18 Revenue, IAS 37 Provisions and Contingent Liabilities, IAS 38 Intangible Assets. The aforementioned accounting standards form the baseline to be used by enterprises wishing to be compliant with the International Accounting Standards in reporting their financial statements. However, it should be noted that even the non-listed accounting standards are equally important in reporting financial statements. Implementation of the accounting standards. To the surprise of many, implementing the IFRS was not as difficult as many thought, since it was easily and quickly adopted by most nations. About 110 nations throughout the globe have incorporated the IFRS into their accounting systems either as a permitted accounting method or as an accounting requirement. Out of these, 85 countries now require that any company listed domestically comply with the IFRS. Despite the fact that most of the nations, including Europe, India, Russia, and Australia, just to mention a few, have easily adopted the IFRS, the United States of America is in a compromise as it continually pushes for the United States GAAP, Generally Accepted Accounting Principles, to become a universal standard. This has, in turn, led to debates about comparing the United States GAAP with the IFRS, among other international accounting standards. The reason behind this is that for a long time, the United States of America has wanted to control international accounting standards, or rather has a strong influence on them. Nevertheless, the United States of America has in the recent past shown signs of adopting the IFRS, which will act as a secondary system of accounting for those companies in the United States that prefer it. Nevertheless, the United States of America's adoption of IFRS is expected to bring about further debate on which of the two accounting systems, GAAP and IFRS, will be more favorable for harmonizing global accounting practices. With most countries not agreeing to the idea of harmonizing accounting standards, it is agreeable that harmonization would significantly affect international standards. One such country is Vietnam, which has long insisted that those wishing to do business with it have to comply with the Vietnam Accounting System, VAS. However, in spite of being required to prepare the financial statements in Vietnamese, most countries have complied with this requirement to do business with Vietnam. Nevertheless, it should be noted that the harmonization of the accounting standards would bring several benefits. First, the information in the financial statements prepared using harmonized accounting standards will be understood by everyone around the globe. Second, this will increase the level of transparency in business transactions, hence ensuring the success of the global market. Conclusion. From the above discussion, it can be clearly concluded that the international accounting standards, among other international standards, are of great significance in global operations. This is because, in addition to helping people understand the reported financial statements, they also ensure a high level of transparency in global business transactions. One such important international accounting standard discussed above is the International Financial Reporting Standards, which have been adopted by most of the countries around the globe because of the major role they play in enhancing cross-border business transactions.